Good afternoon and welcome to this afternoon's event on a topic of living standards and financial resilience across Europe. We will be looking at this very important topic from three different angles: how the household, the financial position of households has been as we were coming into the pandemic, what happened to the household during the pandemic, and of course what the reaction of policymakers ought to be to try and enhance the financial resilience of citizens. I am Maria de Mertis. I am the Deputy Director here at Bruegel, and today I'm joined with a very distinguished set of experts that had worked very actively on this issue. Romina Boaori, who is the Director at Y Center at the OECD, Joel Darvas, who is a Senior Fellow at Bruegel, and Daniel Tomlinson, who is a Senior Economist at the Resolution Foundation, together with whom, by the way, we are organizing this event today. Now, we have quite a lot of material to go through today, so I don't want to spend much time on introducing the topic. I think our experts can do a much better job in this respect. So with that, Romina, I'm going to give the floor to you. If you can tell us how the household, what the position of the household was as we were coming into this pandemic. Romina.
Good morning, good afternoon, everyone, and thanks, Maria, for this wonderful introduction. And it's my pleasure to be here. So thanks to Bruegel for bringing us together around this very important topic. I'm going to share indeed a few slides that assess this issue right now, and indeed, what was the situation of many countries when the pandemic hit. Before I do so, let me just say, 30 seconds about the work, the fact that we did a lot of work to actually look at economic insecurity of households and in economic vulnerabilities of households, to really appreciate the perspective on of the resilience of households from a multifaceted point of view that looks beyond income, and so actually also looks at consumption and wealth. And this has quite fundamental implications, not just at the individual level and household level, but actually for the economic system as a whole. And so is certainly one topic that we are right now in the Y Center, more generally speaking, the OECD, really doing a lot of work on, as we actually are putting in place strategies to help our member countries to bring forward. And in particular, we are coming up with a recovery dashboard that includes measures of financial resilience. Of course, we also did work that demonstrates that actually the economic insecurity of households is not just important for the current well-being of households today. This has dramatic lasting effects on the well-being of the children across their life cycle. Now really going to the topic of the conversation. So let me just remind that, of course, the COVID-19 pandemic is not taking place in a vacuum. And so this is work you can see in this slide that was in fact done before the pandemic started, but very tellingly, I think, shows that 1 in 3 individuals in the OECD was risking falling into the poverty in the event of a sudden loss of income. So these are people that or households that we don't consider as poor yet, but they really have a high risk of falling into poverty because essentially they don't have enough economic security, they don't have enough assets to withstand any big shock. And so when you look at this type of exercise, what you also see, and in terms of what are the expenditures that households make, you can see that in fact 60% of disposable income of the most vulnerable households actually is used to cover for essential expenditures. And so it means in practice that the arbitrable income of the most vulnerable households is obviously very, very low. We did a lot of work when the pandemic started to really take a look at the very timely and granular statistics that our member countries are putting together to document the impact of the crisis. And it's a very, I would say, challenging statistical job to do. And I'm sure that in the discussion today, we'll hear from the other speakers as well, how challenging is this, coming up actually with numbers in real time that can feed the policy debate. Especially if you want to do so, with this additional, nevertheless, necessary constraint of coming up with, comparable statistics across a number of countries. So we started taking a look at the existing data. And so what we found is that essentially, if you take several measures of financial insecurity of households, you can see that 1 out of 5 respondents reported difficulties in making ends meet during the pandemic. And this is actually was, a funding from the Eurofund 2020 study. Of course, Eurofund, came up with several studies. And so this really particularly, this piece of evidence really pertains to the first wave of the pandemic. But nevertheless, 1 in 5 respondents, so 1 in 5 households says, they really struggle to make ends meet. And of course, it's not any type of households, clearly. We know that the ones that have, the most issue in terms of labor markets, participation, quality of jobs, etc., these are the ones, obviously, that have been hit the most. And in fact, here is what you can see in the second chart, that actually the unemployed ones were the ones, obviously, that experienced the greatest issues in terms of paying their bills. And clearly the unemployed, but also the ones that are inactive, the ones that are in fact at the moment experiencing a very, very slow job recovery. These are also the ones that will certainly have issues, for instance, when it comes, to keeping their housing. Now, of course, the other very important accent we are putting in WISE, that, as I said, this is really looking at the well-being in its sort of all entirety and complexity, is trying to understand how financial insecurity intersects with other well-being dimensions, because this is actually not important per se, but this is actually what you need to do if you want to address, from a policy perspective, the financial insecurity of households, and you want to make sure that the response and the actions that governments are taking really, sort of come with an integrated strategy to tackle the compounding inequalities across the life dimensions and the drivers of multiple financial insecurity and exclusion. And so what we see here is that the unemployed respondents have been particularly lonely during the pandemic. So these are also the ones that are reporting, the higher dissatisfaction with the life. So the ones that struggle the most, from a psychological point of view. And of course, it's not just the unemployed. Again, I mean, if you look, for instance, also at the ones, that have very low attachment to the labor markets in general, or they have, non-standard jobs, so temporary workers, etc. These are also the ones that, really had, psychological, really a lot of psychological impacts. And so that's when you see that, the financial security, goes well beyond, the just the economic dimension. So we also are finding that, the feelings of depression, of course, has increased in general in the population, and in particular in some groups, notably the youth, the youngest people. But again, we also find that, in fact, the feelings of depression and in general, the deprivation of subjective well-being is higher with the ones that have been hit the most from an economic point of view. Now, of course, these are just very quick results, and we are accumulating many more. But in the interest of time, let me just, in fact, now turn to the sort of policy response and what is needed there to really boost financial resilience and well-being in the context of building back better. So that's where policymakers are today, and all of them, obviously very reassuringly are, really trying to redesign the system as we go forward. And of course, it must be said that those impacts that I just very briefly discussed, I've been there, even if, we really did see unprecedented action at policy level, and notably, and in the forms of increased income supports, unemployment schemes, and social protection. And so this is, of course, very, very, I mean, that certainly has to be commended. But the question is, what do we do now? How do we activate a recovery? And even more importantly, how do we make sure that whatever is done now to build forward from a government's point of view is actually there to also build resilience of the most vulnerable households, And so, of course, we're looking at resilience along the sort of three axes, and these are sort of three components. But I thought I would record them today because they're always useful to, understand what we mean by resilience. So there is a first dimensions of resilience, which is about absorbing a shock. So really trying to understand what are the capabilities, what are the opportunities, the resources that the most vulnerable households have in the first place to withstand, absorb and minimize the shock. So that's the first component. The second is, the adaptability, to what extent the most vulnerable households are actually capable, to adjust, for instance, in terms of finding a new job or in terms of reskilling themselves, how they are able essentially to really very quickly move, into a situation where they can sort of take advantage and benefits of possibly new sort of economic opportunities at a time where, of course, there is immense restructuring happening really at the economy level. And finally, there is the third sort of element, which is a little bit more sort of a strategic and forward-looking. So the transformation, the issue of resilience, and in fact the issue in general where we are today, is that there is still a large uncertainty, an incredible uncertainty. And so if you're thinking in terms of how you want to boost financial resilience, you also need to think in terms of how do you essentially protect the households in a way that allow them to, or to actually equip the households in a way that allow them to sort of be prepared for the next shock and be able to anticipate in the most possible way. So that is sort of the more ambitious transformation action that is needed. Here are a few ideas, a few very concrete policy suggestions that are coming from our work that we did at the OECD in the context of our Inclusive Growth Initiative, and we launched, in fact, some time ago, the framework for policy action on inclusive growth. In fact, this is a framework that predates the pandemic, but nevertheless, it does contain, of course, a number of interesting lessons that we could draw from the experience of the most successful countries in terms of reconciling positively growth and a strong sort of economic model with inclusivity. And so particularly, when we're looking at the implications of this framework from the perspective of boosting financial resilience, there are a few key actions that emerge, and I'd like to highlight. The first is the very important, I would say, urgency to address the rising cost of living and investment and investing in future well-being. So in terms of, for instance, looking at what are the education possibilities, the health, the accessibility to the health system, to obviously quality, and good health care, and of course the housing. And so here, perhaps just a reminder that even before the pandemic, we did a lot of work that actually documented the fact that it wasn't just the lowest income households, the bottom 20%, but actually was the middle class as well that was facing the highest increase, in the price of the most essential services. But as I said, also in the goods and services that are there to invest in future well-being. And again, this is related, of course, to the issue of child poverty, and more generally speaking, to the fact that obviously the most vulnerable households are incapable, to invest in the education and the health of their children, with again long-term consequences if, of course, they happen to live in countries where the cost of those services increases. There is another interesting action. This is quite, it's perhaps less at systemic level, nevertheless quite punctual, I think quite interesting to look at essentially the practices that feed the poverty premium when it comes to tariff for essential goods. And this is not necessarily what we've done ourselves, but we've heard and learn, from interesting initiatives looking really at the calculations of the poverty premium that essentially poor households have to pay. And you look at the regulation in some countries, and that regulation is not necessarily fit for purpose in terms of really eliminating, let's say, the risk of poverty premium. And then, of course, there is the actions around financial literacy, and that is a very, very comprehensive one that is required here, but ones that, again, we learned that in the context of the current pandemic was quite fundamental. Of course, vulnerabilities in the labor markets through active labor markets and skill policies. This is, I think, is the most compelling example of any action in terms of boosting the resilience of households. So again, active labor market policies, again, in a way, are perhaps the best, the emblematic, I would say, type of policies that is needed, in this particular point of the cycle, but also all the skilled policies, and just to conclude, and of course I'll be happy, to go again through this with much more detail and depth if there are specific questions. But of course, the question of social protection and the accessibility to benefits to vulnerable groups. It was interesting to see that in a way the pandemic gave the pretext to huge experimentation to governments that had to almost overnight come up with new social protection packages. And again, there was a lot of innovation, interesting innovation being that we saw there. But we also know that, of course, not all households really get good access to those benefits. The one that really are very much behind, the one that really sort of excluded, including because they don't have any any way to learn, to have the information. They obviously are completely disconnected also digitally. So these are still the ones that have not been reached. In fact, including even if during the pandemic, as we said, the effort of course to increase and better target the social protection services as certainly large and on the rise in many countries. And of course, the issue of private safety nets, it's not just what governments can do, but clearly there is also a bigger action in terms of supporting households, in terms of long-term and saving strategies that of course pay off in times of crisis. So here I'd like to stop and just remind that, of course, we have a very specific report that is coming up presenting some of the results that I show today, but that's a report that, of course, I'll be happy to tell you more about in the future. Thank you.
Wonderful. Thank you so much, Romina. Thank you for giving us so much information in so little time. Lots of very interesting things. Thank you for pointing out the need for timeliness of statistics. None of this is possible if we don't have the numbers. So that's an incredibly important point. Perhaps we can come back to some of the issues that you raised, particularly the intergenerational effects, which we don't emphasize enough. You talked about vulnerable groups, and I think this is perhaps one we can focus in a little bit more. And I think Zsolt actually in his presentation will take over this issue of inequality and how inequality might have been affected during the pandemic, which I think, of course, is a very important aspect dimension of this. And then I really liked your three axis ways of approaching on the policy side, how to ensure the absorption, the adaptability and the transformation. Perhaps we can come back to this in the discussion. But for the moment, I'll go to Zsolt. Zsolt, you've written a big study and smaller studies on these types of issues, and you always emphasize the issue of inequality. Tell us a little bit more about your findings.
Thank you. Thank you very much, Maria. Let me share my screen.
Yeah.
I hope you can see it.
Yes, it's fine. Thank you.
I also prepared a few slides, and I mean, this opening slide is a bit heavy because I listed the two reports which I used to prepare my presentation. Now, first of all, we prepared with Katerina Midos a large study on wealth distribution and social mobility. I mean, Romana Buarini already mentioned in her intervention that wealth is a very important factor, and also the OECD prepared a lots of interesting reports on wealth distribution. I mean, in our report, we also looked at many different aspects, and certainly in a short presentation of 10 minutes, moreover, we were asked to prepare only 5 slides. Certainly, I can't give even a snapshot. But what I will do is that I highlighted 3 particular issues which are related to financial vulnerability and the possible impacts of COVID. So that will be 3 slides on this wealth distribution paper. And the remaining 2 slides will be on the inequality impact of COVID. That will close my presentation. But let me first start with the 3 observations that I would like to give you concerning wealth distribution. And the first one is, maybe some people know, some people not much aware of that the income and wealth are not always distributed the same way. I mean, one can think of obvious connections. If somebody is very rich, then that person will earn a lot of income, let's say from dividends or interest or rental incomes if someone rents out houses and apartments. So there is an obviously quite strong association between the two, but it's far from being perfect. For example, if we look at who are the top 20% richest people in terms of wealth, and who are the 20% of highest earning people, then we see that these two groups, so the top 20 in terms of income and wealth, overlaps only one half. So only one half of the top wealth people are also top income earners. And if you look at the bottom 20%, the difference is even bigger, just 1/3. So 1/3 of the poorest 20% in terms of wealth are also the poorest 20% in terms of income. Now, why is it important? I mean, it is important because financial vulnerability depends both on wealth and both on income. Because if income is lost, for example, because of unemployment, wage income is lost, or companies withhold dividend and don't pay, then people will have to survive from their earlier previous financial savings. So how much savings they have, which they can use to pay for their daily needs, matters a lot. So the differences in income and wealth distribution is quite important in assessing vulnerability. And so far I talked about at the individual level, but the chart which is shown on this slide also shows a similar association at the country level. So on this chart, on the horizontal axis, you can see the Gini coefficient of wealth inequality. You can see the numbers are very large, going from about 55 to almost 80. And you can see that the highest numbers are for the Netherlands, Cyprus, Germany, and Austria. So these are the 4 countries which, at least according to a data set from the European Central Bank, have the highest level of wealth inequality. And on the vertical axis, you can see income inequality, and you don't see any big association. For example, in Lithuania, Italy, and Greece, income inequality is comparatively high, but wealth inequality is comparatively low. So it's quite interesting that these differences in wealth and income does not only relate at the individual level, but also across countries there are differences. So this was my first point. My second point is relates to those who have negative net wealth. I mean, you can have a negative net wealth if your debt, like mortgage debt or whatever debt you have, is larger in absolute value. Then that this is not really the case. The only exception is the Netherlands, then this is a significant impact. But for other countries, for the 21 countries for which we have data, we find that the overwhelming majority, 80% of people having negative and would deserve.
Yes, okay. Just a big apologies to our public. We lost actually connection. We are back now, and we're going to do the 2 last slides from Zsolt, and then we move on to Daniel. Zsolt.
Yes, thank you. So let me just quickly finalize my presentation with these last 2 slides. So what you can see here is 2 charts, one for the European Union and one from the United States, which shows how employment by education attainment developed in these countries. And here I focus on employment and not on unemployment, because in crisis episodes, many people leave employment without joining the group of unemployed people. So employment and working hours are very important, useful information. And what this chart shows is that both in the EU and also in the United States, highly educated people suffered much less, or in fact in the EU, they even gained during the pandemic. So more and more jobs are available for people with tertiary education degree. But those with low and middle level of education, they suffered much more, especially in the United States, but to a lesser extent in the European Union too. And we know that educational level is also very much correlated with income and wealth. Higher educated people are richer and earning more than lower educated people. So it's quite likely that income inequality has also increased during the pandemic last year and might continue this year. And the very last slide shows some scenarios. Also in my calculations, I concluded that in 2020, it's quite likely that countries which were harder hit economically also experienced higher increases in income inequality. Unfortunately, we have to wait some years to see proper data on income inequality for 2020. But by using this assumption, for which I also find some evidence in labor market data, I created some scenarios. And this is shown for the European Union as a whole on the chart that you can see here. Namely, there are 4 different scenarios. The first one is just that income inequality has not changed at all in 2020, which is quite likely. But as a comparison, I put it there. While for the other 3 scenarios, I wouldn't like to go into detail, but each of them could be a realistic outcome. And so what we can see here is that there was a quite decade-long decline in European Union-wide income inequality starting from the mid-1960s. The global crisis made a small reversal to that, but the COVID crisis will likely result in a much more significant reversal. And let me stop here and pass the floor to Daniel.
Indeed, we do that immediately. Daniel, the floor is yours.
Thanks very much. I will whiz through this so we can have a little bit of time for some discussion. Let me know if there's any problems with seeing my screen. So we have published a report today, which you can find on our website there, resolutionfoundation.org. It's a 130-page detailed look at the state of household finances and financial resilience before COVID and also during this crisis. I'm going to skip past that slide as we are a bit short on time, aren't we? So I just wanted to show you a few things from our pre-COVID, from the pre-COVID part of the report. So this first slide here just shows you the income distribution in the UK, France and Germany, which is the focus of this research. And you can see that typical incomes are basically the same in each of these 3 countries. But because income inequality is just much higher in the UK than in France and Germany, actually incomes at the bottom of the distribution, this is working age household incomes before housing costs, are around 20% lower in the UK than they are in France. So this key takeaway here is that your income distribution and how unequal incomes are really matters for how financially resilient different parts, particularly the lower end of the income distribution, will be. And the low income in the UK is in part a cause, though there are many other causes as well, of some of the key findings from our pre-COVID work. So we see that saving rates and levels of savings are lower in the UK than in France and Germany. 2/3 of low-income households in Great Britain have savings that are equivalent to less than 1 month's disposable income. Households in the UK are also more likely to have debt. But on the flip side, it is worth noting that households in the UK have much greater housing wealth than households in France and Germany and in many other European countries. And that's a product of 2 things. One, that there are more people who own their own home, more home-owning households in the UK. But 2, that house prices are just significantly higher. And so whenever we're thinking about differences in saving rates and saving levels across countries, it's really important to think too about how lots of households in the UK at least are not saving into a savings account, but are saving through paying down their mortgage and through home ownership. Different challenges in France and Germany pre-COVID are low employment rates in France and actually high worklessness at the bottom end of the distribution in Germany. And there's a few findings, quite a few in our 130-page report that's out today that shows actually the bottom of the distribution in Germany looks much more like the UK, or in some cases worse than the rest of the distribution. There's a standout that there's some standout and particular problems at the lower end of the income distribution in Germany pre-COVID. But moving on to what's happened in this crisis, one key finding from our research, which we've conducted a bespoke survey in the UK, France and Germany in late January and early February to provide one of the first insights into what's happened to households' financial resilience. And we can see that more households in France have moved out of work, but of those who have experienced a job loss, the income fall is just much greater in the UK. And we can zoom in, as I do on this chart, at those households who have experienced and in which someone has lost their job and then they've moved on to claim unemployment benefits. And you can see that in the UK, of those households, 35% have experienced an income fall of more than a quarter, which is a larger share, 35%, than the combined share of households in either France or Germany that experienced any income fall from moving on to unemployment benefits. And that just really goes to show just how important the adequacy and the generosity of your welfare system is. And we can talk more about this if we have time, when you have households moving into unemployment, and also shows, particularly for the UK here, how important it was that a furlough scheme was designed and introduced to protect households from these quite large income falls. I just wanted to show this chart, and it shows you that lots of households have had to take some action in order to manage their housing costs, which is one of those big fixed costs that we can't really move when incomes fall. And you can see that action, fewer households in Germany in general have taken action, either reducing spending, using savings or borrowing money. But again, we can see the lowest income households in Germany looking much more like those in the UK, 40% having to take one of these actions in order to be able to continue to manage their housing costs during this pandemic. And then a final chart here just on debt. And we can see that just looking at the right-hand side of this chart, of those households for whom their income has fallen during this crisis, 17% in the UK have had to turn to debt in order to cover their living expenses, which is twice as high as the rate in France and Germany, and links back to our pre-COVID findings that households in the UK were more likely to take on financial debt and also had lower cash savings that they could draw down on, cash or current account or savings account savings, to draw down on in the case of a shock. So the key lesson, and I won't spend that long on this final slide, but the key lesson here is that policymakers need to think not just about what's gone on in this crisis when they're thinking about the policy solutions, but also what the long-standing challenges have been in each country, and get into the detail as well of what those challenges are when they want to think about policies to help families recover from this pandemic. Thank you.
Thank you so much, Daniel, and for my apologies again for rushing you. No, I thought your message was very clear. So there's a lot, all of you, that you have touched upon. I mean, I think the one key message that I hear is about the vulnerable groups, and there are a lot more one can say about vulnerable groups. Think about it would have been interesting to see also numbers on how women might have been affected, given that we know there have been differences on this, or lone parent families. There are some really interesting numbers that Eurostat is quoting in this respect that are really worth talking about, because we are really needing to target measures to the extent that we want to help to those that really need it, as opposed to being indiscriminate in the way that that we're doing, that we're providing help. So with that, I would like us to spend a minute of the little time we have thinking about the policy responses, but not in two different levels. One, in the crisis, what do you do? How do you identify those that are vulnerable and target measures to them? And then to go back to some of the things that all three of you have mentioned, the more structural issues, because you have, Romina, all of you have quoted numbers which are pre-COVID numbers, and therefore they point to vulnerabilities that exist structurally rather than vulnerabilities that have arisen as a result of the crisis. And of course, to the extent that these vulnerabilities have deteriorated during the enormous pandemic crisis, what do we do to try and help those that need it the most? Romina, maybe I can come back to you if you have any initial reactions to what you heard from the other panelists, and I'd like us to have one more round on the policy reactions, given what we heard. Romina.
So I must say, I was really interested to see that there is so much consistency across the three presentation, and really not only in terms of the findings, but actually even the methodologies that these three presentations, they are looking really at, again, the sort of the issues of economic insecurity and vulnerability by looking, not only at income, but also wealth, of course, assets and expenditures, so consumption. And so it's interesting because I don't see this all the time, right? And so I think to me, it's quite telling about the fact that the debate is really now very rich and really encompasses all these three dimensions. And so in respect to that, and before I go back to the policy point, the issue really is that, so what are we counting here, right? And how are we measuring inequalities? And I think, what we see in our numbers, certainly, and it was also said, I think by Salt, is that if you look at inequalities in wealth, you see that inequalities, or actually in the joint distribution of wealth, income and consumption, you find the inequalities are much, much larger than if you just look at income. And so let me make immediately the connection with the policy implication of that, because of course, most of the social protection schemes and programs today are targeted or target income. Okay, and so I think it's rather telling about the fact that unfortunately, the policy, the policy response in the short term, in the crisis, but also, from a more sort of medium-term structural point of view, is one that perhaps insists too much on the issues of income and not enough, certainly, on the issues of wealth. And so I think in that sense, of course, all those initiatives that now are looking at things such as capital endowments, in particular, making sure that capital endowments are distributed fairly across, individuals that obviously come with very different initial levels of income, etc. So that sort of universal, basic capital endowment. This is typically perhaps going in that direction of saying, we need to do something much, much more about, redistributing the resources. So it's not just, punctual in terms of income, but really from the perspective of shaping the wealth of individuals. And also, when it comes to the consumption itself, there again, I think it's there is quite a lot that policymakers can do. For instance, in terms of housing, I think all of the presentations notice the fact that there is an issue in terms of housing affordability. And in fact, we also have done some work in the OECD that actually shows that in the context of the pandemic, for instance, the house prices have increased, not everywhere, so it's not universal, but we saw some places where that happened. Of course, that adds to the pressure, especially on the most vulnerable. And therefore, it's clear that the policy responses can't be just the social protection, the income support schemes. These are, of course, I would say, still the fundamental building blocks. But in terms of housing, for instance, but also in terms of regulating, perhaps the tariffs of some basic expenditure, there's, I think, quite a lot that can be accomplished. So, and then maybe to go back indeed to the point on the additional actions, the issues, for instance, of the financial literacy, which is something indeed where we sort of stressed since long. I think the fact that it's important to ensure that really a large part of the populations can keep sort of financial savings. And they have to be helped in terms of being able to make good choices from the perspective of return risk profile, I would say. And so we did at the OECD a lot of work that essentially looks at the financial literacy of the individuals, at different points in time of their life cycles, of the most young, but also the adults. And essentially, we do see that, of course, the ones that have the best financial literacy, the best informations, they are able, to manipulate numbers and to take good decisions, are also the ones that, for instance, manage to take sort of precautionary savings. And so even things such as, budgeting, plannings, and savings are things that we want to sort of continue working on in terms of helping the most disadvantaged individuals with. And during the crisis, for instance, what also was seen that it was important in some countries to actually come up with very timely advice and counseling services to the ones that were affected. So this is, perhaps the short term is not just, what you sustain over the more medium term, but certainly an action on financial literacy. yeah, is interesting. And perhaps, well, I'll leave the floor to the other speakers, but if you have time, I think it'd be interesting also to reflect not only on the actions of the governments and the, the public policies in the respects, but also perhaps I'll have the opportunity to mention also what some of the corporates and private sector actors are doing in this field, because there are interesting developments on these issues, and I think it could be interesting to share this with the others. But let me leave it here and give the opportunities to the other speakers to comment as well. Thanks.
Thank you very much, Romina, also for touching on, what can we do now? What can we do, structurally? I mean, financial literacy is definitely a tool for the medium term. It cannot help us in the current crisis as an immediate reaction, but it can certainly help us building the resilience in the future. I see there is questions coming now from our audience. Catherine is asking whether we can use the COVID-19 as a clean slate, fix it now so we don't have it later. Again, it pertains to the problem, what can we do now? But also what can we do in the long term? But there's also a question, I think, directly to you, Daniel, coming from Carlos, and it comes from because it is on the UK. And Carlos is asking why, despite similar levels of support during the pandemic, the furlough example, for example, are UK households out of work so much worse off than the European counterparts?
That's a really great question. And the key here for us, in terms of our thinking about why this has happened, is that if someone moves out of work in the UK, it doesn't matter how long they've been in employment, how much they've contributed to this tax system while they've been in work. There's a fixed amount that you receive if you're on benefits, and that's particularly low if you're single and if you don't have children, but it does vary depending on whether you have children or housing costs. And so the typical replacement rate for someone moving from 2/3 of average earnings in the UK and into unemployment is 17%. It's pre-pandemic, but that compares to around 60% in both France and Germany. The gap does narrow somewhat when you include housing costs in the calculation, because the way housing payments are done in the UK is different, but still it's very substantial. And so the answer from the UK perspective here is, well, A, the furlough scheme did a really good job and we shouldn't rush to unwind it. There's still millions of people on furlough in the UK. But also, as that scheme does wind down, we could end up in a situation where more people are still moving into unemployment, but they're receiving that much lower rate of support than in other countries where there's a more contributory system. And in general, on your question around what can policy do, I think it's really crucial to look at the groups that have been most affected by this crisis. And in Zolt's presentation, you talked about people with less education. And one of the really big divides that we can see as well across countries is that young workers have been really, really hit by this crisis, much more likely to work in those sectors where social distancing and lockdowns have had an effect. So schemes to help get young workers out of unemployment and back into work, job creation and job training schemes, I think is really crucial in the here and now.
Yeah, thank you. I mean, I think an interesting thing is, of course, we are judging the outcomes of policies, but we need to also bring a cost element to them. And I know this is a complicated thing to do, but it's important to evaluate a policy not only about how it outcomes, but what it costs, because then you can understand how do fiscal resources, and in fact, as we move through time, are not unlimited. Certainly in the European Union, a lot of countries will come out of indebtedness positions that are a lot worse, significantly worse than they were coming in. So the buffers, as it were, they are diminishing. They are not endless, and therefore understanding not only what are good policies, but are good policies for the money spent. It's an important dimension to that. And of course, we don't have the time to go into this, but I think it's important to reflect on that. How do we address the problem, but in the most cost-effective way? Zolt, why don't we come back to you? Any views on the policies for now and on the policies for the medium term and long term?
I very much agree with basically, again, there's too much agreement in this panel.
That's right.
So I agree with both Romina and Dania. Maybe let me make a transatlantic comparison and highlight one factor in which I think Europe did better than the US, and another factor in which I think the US did better than Europe. Now, I think the aspect in which Europe did better than the US in this really widespread use of short-time working schemes, because that muted the overall employment impact across the continent. And certainly it's good for the workers that they have the certainty that, you know, once the pandemic is over, they can go back to the same job, sit to the same table, and continue where they had to quit. And also good for the company that they know that the workers who come back, they fully know all the internal processes, don't need any new training, and 8 in the morning when they come in, they can start continue the previous job. So I think it was a win-win both for companies and employees. Now in the US, everybody below a certain level of threshold got a black check, irrespective whether they need it or not, which certainly cost quite some money. And certainly there was much bigger fluctuation. You know, I showed that almost 1/3 of low-educated jobs were lost, and maybe US employees got used to frequent hiring and firing and hiring. But still, I mean, such a huge variation in employment, I think, can be good. So I think in this aspect, Europe did better than the US, I think, with these targeted short-term schemes. But overall, again, coming back to the macro side, the US did, and also with all of these Biden new packages, they are doing a much stronger fiscal stimulus. There's a lot of debate whether the US economy might be overheated, whether it might lead to inflation. I mean, these are all valid debates. But certainly it will leave the US economy much faster. And what we need is indeed jobs. So that's the best social policy, is creating jobs. I think the US will also do it better in that sense. So I very much welcome the European Union efforts in terms of setting us this recovery fund and the next generation EU instrument. But I think that member states will have to do more fiscal support to support European Union countries.
Thank you, Zoltan. Actually, now with that, so you're telling us the one thing you'd like to see more done would be more fiscal stimulus and also in comparison with the US, just do more on the fiscal side in the very short term. I also thank you, Zoltan, for pointing out the obvious trade-off between having to do something very fast and having to do something good. I mean, there's always a trade-off, and you've got to find a golden medium point somewhere there while you're reacting to shocks quite like the pandemic. But can I go back to my other two panelists and ask you, you know, from Zoltan, we heard the fiscal is something you would like to see more. What is one more thing you would like to see done to deal with the crisis before we can think about the long term to address financial vulnerability? And Romina, if I may come back to you.
Okay, let me highlight, I think perhaps in response to what you were saying, you know, the cost, I mean, that we should also look at the cost of this. And of course we should, you're totally right, you know, that the sort of the fiscal leeway is not infinite. That said, you know, a lot of work, I mean, it's something we've done not in this specific context, so it would certainly be, you know, need some sort of, you know, update and sort of refreshing. But we did interesting work that actually showed that sometimes, you know, the fiscal returns you know, fiscal stimulus packages can be really, you know, large. And typically, if in that essentially the package entails measures that allows individuals to very quickly, you know, again, adapt and sort of, you know, go back to the labor force. And so I give again the example of the active labor market policies, but, you know, in some cases also the unemployment schemes can be very good from that perspective, because they really buy the security of people, you know, that they help them, you know, in terms of confidence and etc. So that really can be a factor, you know, for finding a new job. And so we did the work that actually showed that in some cases, you know, yes, you need to invest in social protection. This has a cost in the short term, but again, if you do the calculation, you know, in the medium and long term, actually the fiscal returns of that it's much higher, because of course, you know, you are reintegrating the people in the labor market. So these are people that are going, you know, to pay taxes, and so, you know, the revenues are going to be obviously, you know, on the positive side of the equation, and those people also, you know, will not have to, I mean, first of all, will not need, you know, continuous income support, but also these are the people that will do better in terms of health outcomes, for instance, and therefore, you know, some of the expenditure of health will be lower. So that is important to consider, that of course it is a complex conversation, and indeed not necessarily sort of the focus of what we discussed today. But I think it's, you know, there again, let's make sure that in the when we're talking about fiscal sustainability, we sort of don't forget the fact that, any action that is done today should be evaluated, not just from the perspective of, the change in the economic well-being and the other dimensions of well-being today, but also, the sort of the implications for the future. In terms of what more should be done today, maybe what I would say, what I see a lot of it on the conversations and, concretely the decisions that are being taken in some countries, there is quite a lot of focus on the investments. Okay, and so really from a very macroeconomic point of view, and we hear a lot about sort of infrastructure and that sort of things. And in general, I think it'd be important that we think in terms of how
I think
we've lost her.
Yeah, we lost Romina. Hello, Romina?
We've got tech gremlins today. Should I just do a quick answer to your question?
Why don't you do that, Daniel? We'll come back to Romina when she gets us. Yes.
Come back. So I think for me, there's two quite boring things to say, which is you should roll out the vaccine quickly and not delay in implementing any restrictions that you need to implement if your case numbers are rising fast. I think that's a lesson that we've learned in the UK, and it's a lesson that's relevant to every country. So that's the big picture. On a more micro level, I think one of the things that's come through in our research is just how many families have had to do things like borrow or draw down on savings or reduce their spending to meet their housing costs. And so it's a difficult and knotty policy area, but thinking about how can governments help get the most appropriate balance between who has to face the costs of this adjustment in this pandemic. So at the moment, it's lots of renters themselves who are having to either reduce their savings, which is sort of okay, but in other circumstances, either having to draw down more debt or to reduce their spending, both of which are bad for the macroeconomy and bad for the individual household finances. So at the moment, it's the renters who are dealing with most of that pain. But there's a question about the extent to which people who are receiving the rent or the government itself should in some way find a way to help households deal with those costs. One of the things I think that came out a little bit in the research, which is buried in the report, is how actually we did find that more households in Germany were in arrears on their rents than I think more than I expected at least. And I think that part of that is to do with the fact that private renters in Germany have more security of tenure. And so they're more able to slip into arrears than in other countries. So I think that's another dimension that could help. And in the UK, we've had bans on people being evicted from their homes, and they are set to expire soon. But those sorts of areas, thinking about how people can deal with their costs as well, would be one that I'd want governments to be looking into.
Yeah, indeed. So this is on the legislative side, right? I mean, making that possible is, of course, an incredible relief for renters. So, no, I certainly share that. I also wanted to thank Romina. I'm not sure if she is hearing us, but I wanted to thank her for making this point, which I think is a very important point, that the link between the financial resilience, but also greater other well-being resilience. We don't making just financial decisions. We are making also decisions that have got impact, not only on more general topics, but also, as we heard from her in her presentation, also intergenerational, and to see that the COVID-19 effects on the economy and on the households are going to be felt by children of family, in generations. That really is a wake-up call in terms of the needs for solving the problem now, but ensuring that also we put the right structures in place for future shocks to be better buffered, right? Now, with that, I think we've exhausted the time. I wanted to thank both of you and Romina, if she's listening to us, for coming today to talk about a topic that is, of course, cross-cutting. It affects all of us, and it's crucial that we have better ways of dealing with it. I again apologize for technical difficulties all the way till the end, but in any case, I thought that was a very interesting discussion. And again, thank you for taking the time to join us. I hope we'll have an opportunity to talk about these issues, these very important issues in the future. Once more data becomes available, and also what to do and evaluate policies. So with that, Daniel, Zol, thank you so much for joining us. And I also want to thank the OECD for sending us their expertise. And I hope to see you in some other event. With this, have a very good afternoon.